When I was a kid in the late 80s and early 90s, it wasn't as easy as it is today to get hold of music that you liked. There was no question of streaming and downloading because nobody had internet yet. There was a huge lag between the music getting released in America, where all the music came from at that time, and it reaching Bombay. So we paid the kids who traveled to America during the summer break to bring us back the latest music, which they brought on cassettes. We paid them in chocolates, stationery, and days of designated lunchbox surrender. All sorts of barter. The point is, those kids made a killing simply because there was a time difference between the music that was released abroad and when it released here. The trader who indulges in the practice of buying a stock and selling it simultaneously on two stock exchanges with the goal of earning from any price difference works very much like those kids who we paid to bring us music. The trader, like the kids, looks to capitalize on timing differences. This is because timing differences might result in pricing inefficiencies. As a result, the trader might be able to sell at a higher rate than what he bought at. This practice is known as arbitrage. International arbitrage refers to the practice of buying a foreign stock and selling it simultaneously on two stock exchanges with the goal of earning from any price differences. Here, the trader might bank on both the timing differences as well as exchange rate fluctuations that could result in pricing inefficiencies that the trader could in turn earn from. Just to make it easier for you, here are 5 things that you must know about arbitrage if you are intending to start pursuing it as an avenue for earning. Number 1. International arbitrage is seen as relatively low risk because a trade only happens when there already exists a pricing discrepancy that a trader can earn from. Number 2. Can earn from must factor in the price difference but also the price of carrying out the trade, including brokerage, consultation, technology, and any other costs. Number 3. What technology costs, you ask? Well, technology works both ways. An obstacle to earning in international arbitrage and also the means to earning in international arbitrage. This is because technology has made pricing discrepancies far less common. But technology also stepped up for readers to get instant alerts whenever a pricing discrepancy and therefore a profit to earn exists. Traders who trade in international arbitrage rely on computerized trading systems that are programmed to monitor and alert them about price fluctuations. Number 4. As you might have gathered so far from the discussion, any pricing inefficiency must be acted upon immediately, like absolutely immediately. See, international arbitrage is a very right now kind of a trading route. A couple of seconds here and there and the opportunity is missed. It's kind of like popping soap bubbles. Either you pop the bubble as soon as it forms or it pops itself. No time to spare. Number 5. The reason that the opportunity vanishes into thin air so quickly is that arbitrage traders the world over will be alerted about the opportunity. Everyone who is awake and available will jump in on the opportunity. So the available stock on the stock exchange displaying the lower rate could really run out. Alternatively, the rates might get corrected by the concerned stock exchange, resulting in the opportunity expiring. Number 6. Just like it is legal, encouraged and even necessary to import goods from another country and sell them in India, so is also arbitrage, is seen as a necessary activity in the trading universe. Let us understand this with an example. A trader learns that a given stock is going for $10 on the New York Stock Exchange and for $12 on the Bombay Stock Exchange. He immediately buys 100 shares from the New York Stock Exchange and sells it in the Bombay Stock Exchange. He is now dancing around the office and on social media about his $200 profit. While we are at the topic about international arbitrage, you must also be aware of other forms of arbitrage that are carried out, namely triangular arbitrage and cash futures arbitrage. In a triangular arbitrage, a trader will exchange currency at one rate with one bank, then at a better rate with a second bank, converting it back to the original rate at a third bank, capitalizing on the fluctuating exchange rates at different banks. In cash futures arbitrage, a trader learns that the cash price or a stock market listed price of a given stock is say 100 rupees and the futures price, that is the price mentioned in the futures contract, is 120 rupees. He will buy on the stock market and buy a futures contract to sell the stock at 120 rupees. This difference or discrepancy usually occurs at the beginning of any given month. This is just another option or investment avenue for traders who like the idea of arbitrage. International arbitrage is popular and may seem like an attractive avenue for earning on stock market, but all stock market transactions are subject to market risk, and as such, traders must trade with small amounts until they find their feet. Also ensure that trading is only conducted with spare capital or savings, such that in a worst-case scenario, one's day-to-day life remains unaffected. Please bear all of this in mind while you're trading, and like I've always said, angelbroking.com is your best friend to become a better trader. So go ahead on the website, check out the podcasts, check out the videos, read the blogs, become a better investor, become an educated investor. I'll see you again on a different podcast. Till then, you take care and happy investing.